Welcome to the options trading strategy video series. So in this particular video, we will be covering about covered call writing strategy. So what I'll be doing is I'll take you through brief overview of covered call writing. Then I'll be taking you through some basics of covered call writing strategy with an example. I'll also be showing you two ways to execute this strategy. Number one, using covered call writing to generate consistent returns over existing investments. And number two, how to anticipate a bottom in the market with minimum risk. I'll also be looking into instrument selection and which conditions are suitable for executing this strategy. Also in the end, I'll be showing you how to manage risk in this particular strategy. So let's get started.
In this channel, we talk about trading, investing, and market analysis to help you become a better investor and trader. So if you are new here, consider subscribing.
So the first part that I would like to cover is covered call writing basics. Now in the previous video, we have seen how selling options can be risky, especially if you don't understand the underlying risk. Covered call writing essentially enables you to write options at a substantially lower risk. In this strategy, you buy a stock and then you sell equivalent amount of calls at strike price higher than the buying price of the stock. Now this part will be more clear when we get into specific examples. But for now, you need to understand that this strategy is typically used for generating income in market. But I'll also be showing you that how you can use this particular strategy to bottom fish in market with extremely limited risk. Now this was traditionally used only with stocks, that is a combination of equities and options, but you can also take up combination of futures and options to execute this strategy successfully. So I'll just begin with the basics now. So covered call writing is basically a neutral strategy where a trader expects the stock or essentially the price of the asset to remain in a range. Now this is mainly because a trader typically writes calls in this strategy, and when price moves within the range, he allows time to work in his favor. Due to time decay, a premium would be eroded, and that is where he stands to benefit. This particular strategy can also be used as a hedge against a long position in an index or a stock futures. So if you're very bullish, you should just be holding a normal stock or index futures. Don't get into this covered call strategy because your upside would be limited. And in case you're very bearish, you should just avoid holding the stock, as the premium received, that is the net premium received when you sell the call option, that is higher strike call option, that would not offset the losses that you sustain from a falling stock or index. Again, all this particular technical details of this slide would be clear in the upcoming slides. So I'll directly move to examples and risk profile of this particular strategy. Now let me take a hypothetical example here where I'll be taking an example of stock ABC, which is trading at rupees 60. So in order to create a covered call strategy, what we will do is we need to buy the stock first. This is the first step. So let's assume we have bought 100 shares of ABC at rupees 60. The second step is now to sell calls at higher strike prices. Now we will now sell a call of 65 strike price at premium of rupees 3. So let me just rewind this for you. Stock purchase price is rupees 60. Call option written is at 65 strike price. The premium received for the same is rupees 3. So I'll just get down to some basic calculations for you. So we'll calculate maximum profit, maximum loss, and the break even point. Now maximum profit in this particular strategy is defined with this particular formula. That is strike price plus the premium received minus the stock purchase price into the quantity that you purchased. So just recollect, the strike price was 65, premium received was 3, and the stock was purchased at 60 rupees. So maximum profit that you can get in this strategy based on what example we have created is rupees 800. Now what about maximum loss? Maximum loss is defined as stock purchase price minus the premium received into the quantity purchased. Now what would that be? 60 was the stock purchase price, 3 rupees was the premium that we received. So that is 57. 57 into 100, that is the quantity we traded, that is 5700. So what would be the break-even point according to this strategy? It would be stock purchase price minus the premium received. That is 60 minus the 3 rupee premium that we received. So break-even point is 57. Now I'll just put out the risk profile chart for you. Now, as we saw in the previous slide, 57 actually becomes the break-even point. The maximum loss that we can undertake is 5,700. That is if the stock goes to zero. Now, there is one thing I want to tell you here, that just recollect that we actually bought the stock at 60 rupees 100 quantities. So we had a net outflow of 6,000 rupees, right? But if you look at this risk profile chart, the maximum loss shown here is only 5,700. The reason is because you have written a higher call in this strategy, you have lowered your risk essentially by rupees 3. So the key takeaway from covered call writing is that it reduces the risk of an open underlying position. That is, if you hold a simple long position in an index or a future, or let's say a stock, covered call writing essentially reduces the open risk. In this particular case, the risk was reduced by rupees 3 per share, right? But you also need to remember one thing, that your potential profit will also be capped. Look at this stage. It's mainly because once your stock starts getting higher than your call strike price, you start to lose money on that. So your underlying stock position would actually make money, but your call position that you have written, that would actually begin to show losses. So which is why you would ideally want your stock to stay in a particular range. In this particular case, had the stock fluctuated between, let's say 55 or 62, you would have realized maximum gains for this particular strategy. So I hope the basics are very clear. In case you have any confusion, just go back to this particular slide where I've explained this covered call strategy with an example. So now we'll be moving to a section of covered call writing, how to use this as an income generation strategy with your existing long-term investments. Now, covered call writing, when it comes to as a strategy, the thing that you'll hear first is that it's an excellent strategy to generate consistent monthly income. Now, while this is true, I think you do need to reach a certain level in terms of trading experience before you can do this on a consistent basis. Now, what typically traders do is that in order to generate some monthly income, they typically buy a stock and then they go on and sell a higher strike price call in order to benefit from price remaining in a range. Now, in my opinion, this is not the smartest way to do, because by this particular method, you are not allowing time and volatility to be on your side. Now just think of it. If today you go and buy a stock and then sell one strike price higher call option, you are just expecting too much from the stock, that it is not supposed to move till expiry, which may be 20, 15, 10 or 8 days away. A better way to do this is to do it with your existing long-term portfolio. That is, in order to execute this strategy, you would require a stock in your portfolio that is already delivering about 20% or more returns to you. Now, in the short term, you should not be expecting that any major bullish move should happen in the stock, and this actually should preferably be confirmed on a chart. Now, again, if this part is slightly confusing, I'll repeat again. How this strategy is traditionally executed is that traders look at it from a monthly income generation point of view, and they go out and buy a stock and sell a higher strike price call option to benefit from the same. What I am suggesting, that is the ideal way to execute a strategy, that is, you do it on a stock that you already hold for the long term in your portfolio. It's already delivering returns for you, and over the short term, you don't anticipate any strong movement in the stock. And this is where you go and execute this strategy, because while the long term is very bullish for the stock, in the short term, or let's say the medium term, stock is moving lower and you want to generate some income over it. Now, through this, what you would do is you would continue to hold the stock for the long term, get dividends over it. You can even reinvest those dividends. And just in the short term, when the stock is not doing well, you will use this covered call strategy, call writing strategy to generate some additional income while your stock is moving in a very tight range, or let's say it's just mildly bullish. So one of the key things that you will require heading ahead is the art of instrument selection in this particular strategy. Now, in my opinion, instrument selection plays a pivotal role when it comes to getting success out of this strategy, because out of your long-term portfolio, you will first need to divide your stocks into high beta and low beta stocks. Now, low beta stocks are less volatile stocks, and you should be targeting those stocks specifically. These particularly belong to the defensive sectors, that is consumer goods, FMCG, IT, pharma, and other such sectors. The reason why you need to avoid high beta sectors and stocks for this strategy is because you don't want excessive price action either on the downside or upside, which is typically associated with high beta stocks and high beta sectors. Now, once you are done with instrument selection, I'll just list out some key points in the next slide which you have to follow in order to execute this strategy. So the first thing that I'll tell you is stay away from covered call writing when you have an earnings season underway. Now, usually in earnings seasons, there are some strong surprises, that is positive surprises in the market, and there are some negative surprises. In each case, stock would actually respond in a violent manner, because you do see that in earnings season, sometimes stocks do open up, let's say 5 to 10% up, or even 5 to 10% down. Now, for this strategy, you should typically not want such sort of volatile movement, and which is why in earnings season, you should just stay away from covered call writing strategy. When it comes to holding period, you should be willing to hold the stock over a period of 3 to 4 years at least. The main reason is that a stock takes time to have an up cycle and a down cycle. Now, this whole cycle, that is a cycle from where stock goes from the bottom to the high point, this plays out over a period of 4 to 5 years. So in case you want to execute this strategy for long time, you need to stick with those stocks only which you don't intend to sell over the next 3 to 5 years. In up cycles, stocks will automatically deliver returns for you because you're holding equities. But when the down cycle comes and the stock starts to consolidate, or let's say fall a little, you can sell calls every month to minimize your losses on portfolio and even to generate some extra income for yourself. The last thing that I want to focus upon is quality. Always focus on low debt and high ROE companies in this particular strategy. This information on low debt and high ROE is available on screener.in for free. I'll just leave the link in the description box below. So let me just repeat what I've summed up here. The way to generate income with covered call writing strategy: first, you need to hold a stock at least for 3 to 5 years, which is already delivering returns to you. When stock is in an up cycle and you're identifying momentum in it, you should not be selling calls because the stock or the index would automatically deliver returns for you. But when it comes to down cycle or a stock which goes under consolidation, you should be looking to sell calls every month in order to generate additional income or offset the losses that you are seeing in your portfolio. So the next segment of the strategy that I want to focus upon is using covered call writing to identify bottom in the market. Now, trying to identify bottom in the market is not easy. It's really difficult. Even the professionals struggle to do so. The main reason is typically in such times, volatility is very high. News flow is not in favor of the market in general. More than price uncertainty, your mind actually is under a lot of stress just looking at what is going on. And it is in such times that you need strategies that will lower your overall risk in terms of your positions, and even the psychological stress part, you need to keep that in check. So this is where I feel that covered call writing comes into play. It's extremely helpful to create a strategy that will limit your risk on the downside, and you would be in a position still to try and anticipate bottom in the market. Now, for using covered call writing as a hedge, you need to select the right instrument. The first requirement, in my opinion, is that of let's say a stock futures or index futures, it should be highly liquid. Now, usually futures, whether it is index futures or stock futures, they have good volumes, but you need to worry about the options volumes, because you may have seen that stock futures would be having good volumes, but when it comes to option volumes, options are not that liquid. So, which is why some of the stocks in F&O segment in our market, they don't have good volumes in option segment. So make sure you check this first, that whichever stock or index futures you are selecting, they should be highly liquid. You should also have a basic understanding of what options is and the basics of options, which is how delta and theta impact option pricing. Now, in case you don't know about how delta and theta are impacting your options price, you won't understand much that I'm going to explain in subsequent slides and the next video. So I would actually request you to go back and see the video on part 1, part 2, part 3 in options trading, where I have actually explained these concepts. So I've put the link to those videos in the description box below. So look at the chart here. Now, two things that make it difficult to identify bottom in the market is volatility and the impact of that volatility on your trading mindset. Now look at how this chart is trending down. Look at the frequent gap openings that you're getting. Sometimes price opens lower and rallies during intraday. So this particular scenario becomes extremely difficult to trade. If you're attempting to buy at this point or any of these given points without a proper hedge in place, then let me tell you, 90% of the time you will exit the trade, because the trading mindset is such when we see prices moving lower. So in case you're attempting to catch the next up cycle and you're somewhere here or you're somewhere here, this covered call writing strategy comes in very handy, because once you create a covered call writing strategy at this place or at this place, and even if the price goes on to make low, a new fresh low over the next few days, you would still be able to generate some returns or actually limit your overall losses. So that directly has an impact on your overall trading psychology, and you intend to stay much longer in that position, rather than if you don't hold a properly executed hedge for your positions. So I'll just outline some steps for you that will help you create a proper hedge for your position. The first step is to identify the right instrument. Make sure that for your particular instrument, there is high volume in options segment. The second step is to actually open up your covered call writing position. That is, you need to enter the stock or stock futures or index futures, depending on what you are trading. Take a note of spot price. Third step is strike price selection. When it comes to call writing, this should be 1 to 2 strike prices away. So hypothetically, let's assume you want to enter XYZ, the spot price is 10,000. Your call option selection, that is strike price selection, should be 1 or 2 strike prices away, which is 10,100 or 10,200. Step 4, take a note of your options premium that you will be receiving while you're writing call options, and take a note of options delta and options theta value. Step 5, you need to calculate how much you stand to lose if price of your stock futures or index futures falls by 1%, 2% or 3%. Step 6, you need to put a rupee value to the potential losses, that is 1% loss, 2% loss or 3% loss. You need to define it in terms of rupee, that is how much rupee or how much dollars you're going to lose if the price were to fall 1%, 2%, 3%, that is your stock futures or index futures. And last step would be to use options to hedge or offset at least 70% of potential losses that can come about in case your asset were to fall by 1%, 2%, 3% or more. So I know these 7 steps are slightly confusing. So what I'll do is, in the next slide, I'll take up an example and calculate each step for you. So again, this is the same slide. This was the theory part of the slide. Now this is the practical side. So step 1 was instrument selection with high options volume. So step 2, if you recollect, was you need to enter your stock futures or index futures. In this particular case, spot price is 10,700 and entry was taken at 10,715. 75 shares were bought. Step 3 was strike price selection. take a look at spot price. It is 10,700. Strike price I had said should be 1 or 2 strike prices away. In this particular case, I have taken 2 strike prices away. That is 10,900 call I'm willing to sell. So the premium of 10,900 call is 94. Step 4 was also to note down delta and theta value. So delta is 0.41 and theta is minus 5.30. So for every 100 rupees price movement that I see in my particular stock, the premium would go up by 40 rupees. Now why 40 rupees? Because 100 point movement has to be multiplied by delta value. So 0.41 into 100 would be about 40 rupees. 40 rupees added to the initial premium, that is 94 rupees, would come out to about 135, I think. Now each day your option roughly loses 5.3 rupees of premium value. How do I calculate that? Look at the theta value, which is why in the first place I told you, if you are not understanding this delta and theta concept, go and watch part 1, part 2, part 3 of the options trading strategy videos that I've already done, so that it's easy for you to grasp these concepts. So step 5 was that you need to calculate how much loss you would take if your price falls by 1%, 2% or 3%. So 1% of 10,700 is 107, 2% of 10,700 is 214, and 3% of 10,700 is 321. So I've calculated the net points loss that you would take on your underlying stock position if it were to fall 1%, 2% or 3%. Step 6 was to put a rupee value or dollar value to the loss you would undertake. So that would be your position size into the points here. So 75 shares into 107, that would be 8,025 rupees. 75 into 214 would be 16,050 rupees. And 75 into 321 would be 24,075 rupees. What is this? This is actually the rupee loss you would take if your stock were to fall by 1%, 2% or 3%. In step 7, now you must essentially create a hedge for potential losses, that is rupees 8,000 loss when your price falls by 1%, 16,000 loss when your price falls by 2%, and 24,000 loss when your price falls by 3%. So I hope these steps are clear to you both in theory form and in a practical example form. In case you have not understood this, just pause the video, go back to the previous slide and watch this again, because your understanding of these two particular slides is absolutely crucial for you to execute this covered call writing strategy in terms of a hedge for your overall position. So in the previous slide, we have seen that for 75 shares that we have bought in a stock, if the price falls by 1%, we would potentially lose 8,000 rupees. If the stock falls by 2%, we will lose 16,000 rupees. And if the stock falls by 3%, we would lose 24,000 rupees. Now you need to assess volatility when it comes to bottom fishing, because if volatility is too high, then you need to anticipate for how much movement you need to hedge your overall positions. That is, if the volatility is low, you can account for just 1% losses and create a hedge accordingly. If the volatility is reasonably high, that is above 16, 17 on a VIX index, then you should be at least accounting for 2% risk in your portfolio or the position. If volatility is really high and you are attempting to bottom fish in the market, you should at least expect that whatever positions you take, that is whatever stocks you buy while it's falling, it will at least move 3% or more in the short term, that is against you. So in this particular example, what I've done is I've assumed that volatility is somewhere between 16 to 17 and 18 when it comes to the VIX index, and I've accounted for 2% risk. So if I have bought 75 shares of a stock which is at 10,700, I stand to lose 16,000 rupees if it goes down by 2%. So now I need to create a hedge for myself so that I can bring down this overall risk. So what I'll do is, we saw in the previous slide that a 10,900 call option that we are about to write, the premium value for the same is 94. So if I write 75 units of 10,900 CE, that is call option. And why 75? Because 75 is the shares that I've bought in that particular stock. So once I write or sell 10,900 call option, I receive a premium of 94 rupees. So 94 into 75 would be 7,050 rupees as a credit because I'm writing a call option here. So in case I don't create this position, my open risk without hedge is 16,000 rupees because I'm accounting for at least 2% fall in my stock when I buy the stock. But as soon as I sell a call option of higher strike price, mind you, my buying price was 10,715 and I am writing 10,900 call option for a premium of 94. So the moment I open this position, my risk comes down from rupees 6,050 to rupees 9,000 roughly. The main reason why, because open risk was rupees 60,000 because of the stock position I was holding. But the moment I wrote 10,900 call for a premium of 94 and received 7,050 as credit, my overall risk became rupees 16,050 minus rupees 7,050. So just by creating a hedge, my overall risk has fallen by about 45%. Now this is how you go ahead and execute a proper hedge while you're trying to bottom fish in the market, which is always a very tricky thing to do. But just by creating a hedge and by selling some higher strike price call option, you can actually lower down your risk and still be in the market so that you can anticipate the next upcycle that is going to come about. So up till now, what we have seen is that covered call writing is buying a stock and then selling higher strike price call. We have also covered the theory part of how you can use this strategy to generate income in your own portfolio, that is some existing stocks you have. We have also seen how you can attempt to buy into falling prices by creating an appropriate hedge. Now what I've done is that in this particular video, I have not covered any real life example. I've taken hypothetical example because now we are getting into some complicated option strategies, which is why I'm trying to separate out the theory part and the real life example part. So in this particular video, I've just covered the theoretical part because I'm sure that at this stage, many of you have a lot of questions about this strategy and you would want to watch this video again. So I would strongly encourage you to do that. In next video, I'll be releasing next week. I will be getting into detailed example of how you should be executing both of these strategies, taking an example of Bank Nifty, which is actually the most popular instrument across retail participants. I'll be precisely showing you with real life option trading price, Greeks, and spot price on how to execute this strategy for income generation and as a hedge to limit your losses. So the main points that I will be covering for the next option video would be to look into Bank Nifty as a trading instrument with respect to this particular strategy, how to hold Bank Nifty positional futures and generate income when this positional trade is not doing well for you. I'll also be looking into the important factors to consider while executing this strategy to generate consistent income. I'll also look into attempting to bottom fish Bank Nifty and how you can create a hedge by looking at Bank Nifty options data, by options delta and options theta. And in the end, I'll also be assessing the impact of this strategy in terms of overall risk. So again, if you are very new to options trading, I'll strongly encourage that you watch this video again, because by the time I come out with the next video, I'll be covering up a very specific example with respect to Bank Nifty and how to execute this particular strategy on Bank Nifty. I'll also tell you one thing, that if you've not watched part 1, part 2 and part 3 of options trading series, please do go and watch it, because I'm trying to start from the very basics and then I'm building to advanced concepts. And if you have landed directly on this video, I will strongly encourage you to watch those parts as well, so that there are a lot of terminologies and concepts I've discussed that you should be aware of. So thanks a lot for watching this video. In case you have any doubt, just leave a comment below and I'll get back to you as soon as possible. Thanks a lot, guys. Be safe.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.